Welcome back to the Crow Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We are dialing into a moment of really palpable market stress today. Our sources from Monday and Tuesday, we're looking at Reuters, CNBC, and Bloomberg. They're all painting this picture of, well, synchronized global anxiety.
That's the perfect word for it, anxiety. It's hitting across the board. If we kind of zoom out, the mission today is to unpack these, simultaneous pressure points. You've got investors reacting to soaring AI valuations. You've got brutal volatility in crypto, and then these geopolitical stress points flaring up.
So it's all happening at once.
It is. The overarching theme is that global stocks, US, Europe, Asia, they're all sliding in unison because everyone is just waiting, holding their breath for this high-stakes news, specifically NVIDIA's earnings and that crucial delayed US jobs data.
Okay, let's get into that tension then. We have to start with just how severe the market reaction was. The reports really capture an aggressive slide. On Monday, the Dow just symboled over 550 points. It's a 1.2% loss.
And the S&P 500 and the NASDAQ composite, they both shed about 0.9%.
And that retreat, it just immediately spread, right?
Yeah.
It infected Asia on Tuesday morning.
Instantly. We saw Japan's Nikkei 225 falling, 3.22%, and the Kospi in South Korea dropped 3.32%. Europe followed suit. The Stoxx 600 opened lower by over a percentage point. The gravity of that drop, it is centered almost entirely on AI.
Absolutely. Which brings us to the bellwether of the entire AI boom, NVIDIA. The stock dropped nearly 2% on Monday, and it feels like the entire market is just holding its breath for their Q3 earnings. That's Wednesday after the bell.
The stakes are just incredibly high, and it really boils down to one number. You have CEO Jensen Huang, who previously claimed the chipmaker has, and this is a quote, $500 billion of orders for 2025 and 2026 combined.
$500 billion. That number just hangs over everything.
It's a massive forward guidance, and analysts, according to reports from CNBC, are, they're unified on this. Because expectations are so high, even slightly muted guidance could trigger a disproportionately sharp, painful correction, not just for NVIDIA, but across the entire tech sector.
So what's the primary risk there? With that $500 billion number, is it just the sheer size of it?
It's a fragility of it. That forecast suggests near-perfect, sustained growth. It assumes their biggest customers will just keep building out massive data centers without any delays. If anything, inflation, infrastructure problems, competitive pressure causes that outlook to slip even a little.
The market will reprice it violently.
Violently, because the current valuation depends entirely on that aggressive future promise.
Okay, but here's where we find a really fascinating point of contrast. Amidst all this AI anxiety, Alphabet, Google's parent, it actually bucked the trend. Reports note their shares rose 3% on Monday.
And that rise was purely due to a massive vote of confidence from, the ultimate long-term investor. Warren Buffett's Berkshire Hathaway revealed a substantial $4.3 billion stake in Alphabet,
making it their 10th largest holding. For Buffett, who usually, stays away from these high-flying tech names unless it's Apple, this is a very, very big move.
It is, and there's some great historical symmetry here for you. This investment comes 2 decades after Google's founders Larry Page and Sergey Brin famously cited Buffett's annual reports, specifically that an owner's manual concept as inspiration for their own IPO prospectus.
So the admiration has come full circle.
It's great corporate theater, sure, but the overall sentiment around the AI bubble, it remains deeply skeptical, even among the winners. Reuters reported a major warning from the top, from Google CEO Sundar Pichai himself. He stated that if the AI boom collapses, no company will be immune, including Alphabet.
Which directly questions if these soaring valuations are even sustainable.
It does. How do you reconcile those two signals, right?
Yeah.
You have Pichai talking down expectations, maybe, while Buffett is making this multi-decade play that just ignores the current hype.
It seems like they're operating on completely different timelines.
I think that's exactly it. Buffett is buying on fundamental value. He probably sees Alphabet as undervalued relative to its core business, search and cloud, regardless of the AI hype. Pichai, on the other hand, he has to manage billions in AI investment, and he knows the whole industry depends on a very narrow supply chain and, frankly, speculative future demand. He's injecting a dose of realism.
Speaking of that narrow supply chain, CNBC had some details on a key partnership, ARM and NVIDIA.
Yeah.
This could change the competitive landscape.
It could. The news is that ARM-based Neoverse CPUs can now integrate with NVIDIA's NVLink Fusion technology.
Okay, so for those who aren't deep in the weeds, why is this specific integration CPU to GPU linking tech? Why is that so strategically important?
This is a critical, I'd say, defensive maneuver for NVIDIA. First, you have to understand the term hyperscalers. These are the massive cloud operators, Microsoft, Amazon, Google, and they're the main buyers of all this AI hardware.
And they are all trying to build their own chips now.
Exactly. They're all developing their own custom ARM-based CPUs to optimize their data centers and, reduce their reliance on traditional chip makers. They want more control and they want cheaper setups.
All right.
So for years, NVIDIA's proprietary NVLink has been the gold standard for connecting GPUs. By opening it up to work with these custom ARM chips, NVIDIA is basically saying, fine, build your own CPUs, but you still need our dominant GPUs, and we'll make sure they integrate seamlessly.
So they sacrifice a little hardware exclusivity to maintain their dominance in the long run.
It's a very smart strategic play.
Now, the volatility we're seeing in AI is, mirrored, maybe even amplified, in the crypto space. This just compounded the anxiety for the broader market. Bloomberg reported that Bitcoin slid below that psychological $90,000 level on Tuesday. It turned a general slump into an accelerated rout.
It really did. It erased all of its 2025 gains.
And that drop below 90K, it's not just a round number, is it?
No, it's critical. Because of a specific metric that Bloomberg highlighted, the pain point for institutional investors. It's the flow-weighted average cost basis for all those U.S. spot Bitcoin ETF investors, and it's sitting right around $89,600.
Explain that metric. Why is it more important than just a simple average price?
Well, the flow-weighted average takes into account not just what price people bought at, but how much capital flowed in at that specific price. It's the truest measure of the collective money that's been committed since the ETF launched.
So this is the heart of the new Wall Street money in crypto.
Precisely. And when Bitcoin trades below that 89,600 level, that entire massive cohort is, for the first time, collectively underwater.
And that explains the panic.
It explains the panic. The consequence is immediate outflows. The 12-spot ETFs have already seen about $2.8 billion in net outflows just in November. That level of selling has pushed market sentiment back into extreme fear, and it reinforces this idea that the crypto sell-off acts as a kind of amplified market risk alarm for stocks.
And all this volatility is colliding directly with uncertainty at the Federal Reserve.
Yeah.
It just adds this layer of macro confusion on top of everything.
It does. Expectations for a December Fed rate cut have just receded dramatically. I mean, they were over 90% a month ago. Now they're below 50%.
And the Fed itself seems completely divided.
Oh, absolutely. Based on remarks this week, you can see the split. On one side, you have Governor Christopher Waller. He's backing a December rate cut. He's pointing to the weakening labor market as his justification.
And on the other side,
On the other, you have Vice Chair Philip Jefferson, who is urging caution. He's saying we need to proceed slowly because inflation isn't fully beaten yet.
so that division makes the delayed September jobs report, which is due on Thursday, it makes it absolutely central to the market's narrative this week.
Agreed. That report will likely decide which faction inside the Fed gains the upper hand. Until that data comes out, the market is just stuck in this state of high anxiety.
Okay, let's pivot now to global pressures, focusing on Asia. Countries there are dealing with the tech slump and their own local geopolitical issues. Japan, according to Reuters and CNBC, is facing a kind of double whammy.
It's a huge distraction for their economy, this diplomatic spat with China. It all stems from comments made by PM Sanae Takechi about Taiwan. She said any attempt by China to seize Taiwan would be a survival-threatening situation for Japan.
And China retaliated.
They retaliated by advising their citizens against non-essential travel to Japan, and the economic cost of that is, well, it's not trivial.
Not at all. Chinese tourists made up nearly 23% of all foreign visitors to Japan in 2025.
Exactly. So experts are estimating a potential 1.79 trillion yen drop in Japan's GDP over a year if Chinese tourism just halves.
And to put that number in perspective for you, that single loss is roughly equivalent to Japan's entire annual defense budget. It just shows the deep reliance the economy has on this one revenue stream.
And it comes at the worst possible time, with the economy already contracting.
Now, shifting to the corporate battlegrounds in China, Reuters detailed what they called a brutal AI price war.
Yes, and it's centered around Alibaba's upgrade to its consumer chatbot, Qwen. They've rebranded it from Tongyi and released it as a free app.
Which sounds generous, but it's probably not.
No, it's an aggressive necessity. The price war was triggered by competitors like DeepSeek, who are just offering incredibly low compute costs. But the real context here is that Alibaba is profoundly lagging its rivals in user adoption. We're talking about monthly active users, or MAUs.
The metric that really matters for engagement.
It's everything. Alibaba's Tangi app had only 6.96 million MAUs in September. Compare that to the market leader, ByteDance's Dubao, which had 150 million.
Wow. That is a staggering difference.
It's not even close. Alibaba is in a desperate catch-up scenario. Releasing the app for free is a full-blown attempt to just grab user data and usage stats as quickly as possible.
But not all the tech news out of China is bearish. Reuters data had a strong counterpoint. Apple is performing incredibly well there.
Incredibly well. Sales jumped a massive 37% year over year in October. That's driven by the iPhone 17 series, and it secured them 25% market share.
Which is a milestone they haven't hit since 2022.
Right, and it's not just unit sales, it's revenue, because the average selling price of those premium iPhones keeps climbing. It's also worth noting that domestic brands are strong too. Xiaomi is now number 2, so the whole market is growing.
Let's connect this back to broader macro trends. India is sounding some alarm bells with its trade deficit.
The trade deficit hit an all-time high, $41.7 billion in October, according to CNBC. This was fueled by two things. First, a nearly 200% surge in gold imports for the Diwali festival season. That's seasonal.
And the second factor.
The second is more concerning long-term. An 8.5% fall in exports to the U.S., and yes, that is directly tied to those 50% tariffs the U.S. imposed back in August. The tariff war is having a very real, very immediate impact.
Speaking of gold, which is usually seen as this, non-yielding asset, it declined for a fourth straight day. But CNBC is reporting that wealthy investors are finding a new purpose for gold that completely changes its role in a portfolio.
This is a fascinating innovation. It's the rise of gold leasing. Since gold prices are at historic highs, investors with large amounts of physical gold, we're talking big bars and vaults, are now renting them out.
Renting gold, who's the customer?
Refiners and jewelers. The cost of traditional cash loans is so high they're struggling to finance their inventory. So instead, they lease the physical gold directly from investors.
And the return is paid in gold, not cash. I never thought of gold as a yield asset.
Yeah.
That changes everything about how you'd hold it.
It really does. Platforms like SafeGold are offering 2% to 4% interest, paid directly in physical gold. So you maintain your position, you earn a yield, and you hedge against currency depreciation all at once. Leasing volumes at SafeGold just exploded from $2 million to $40 million since the start of the year.
Incredible. Okay, finally, let's wrap up with Europe's efforts to secure its long-term chip supply chain. Reuters reports the industry group SEMI is urging the EU to, rethink its entire strategy.
They're calling for a complete revision of the CHIPS Act 2.0. The key recommendation is a bit controversial. They want to move funding away from trying to attract first-of-a-kind advanced manufacturing, like those stalled Intel plants.
So stop trying to copy Asia and focus on what Europe is already good at.
Precisely. Europe dominates the equipment manufacturing side of the chip industry. Firms like ASML in the Netherlands, which makes the machines essential for all chip production globally. The industry recommends quadrupling the budget to 20 billion euros, but putting that money into the supply chain's bottleneck, the equipment, not trying to bring fabrication to the continent.
It sounds like a much more pragmatic long-term security play for the AI era.
It is.
So what does this all mean for you, the listener? Whether you're looking at the dizzying expectations set for NVIDIA, the volatility of Bitcoin pulling investors into the red, or the geopolitical risks in Asia. Today's financial landscape is just defined by these high stakes, this tension between technology's soaring promise and the underlying macro uncertainty. It's incredibly palpable.
And this raises a really important question for you to consider. Given that this AI boom is creating immense energy needs, so much so that Alphabet is warning of delayed net zero targets, how quickly will the power and infrastructure bottleneck impact those massive data center buildouts? The very ones that NVIDIA and the hyperscalers are relying on for their, $500 billion growth plans. That energy constraint is a fundamental and, I think, looming challenge to this entire AI revolution.
A truly profound question for the days ahead. We'll see you all tomorrow morning with new headlines from major financial magazines.